Good day, everyone. Welcome, and thank you for joining today's edition of Teneo Insights, our final edition of 2024. I'm Kevin Kajiwara in New York City. This week, Teneo issued its third annual CEO and Investor Outlook Survey, Vision 2025. Where is the world going in 2025 and beyond? Its findings are the aggregated responses of some 700 global public company CEOs and institutional investors, representing about $10 trillion of company and portfolio value. The survey was conducted over the 3 weeks immediately following the election. The headline finding: CEOs and investors are bullish about prospects for growth in 2025 and anticipate strong M&A activity, increased levels of domestic and international investment, accelerated hiring, and advancements in technology and innovation. But geopolitical risk, investor activism, trade tensions, and a new administration that, while promising to unleash the animal spirits, also brings a significant element of uncertainty. Here to discuss the findings and what they mean, I'm joined by two colleagues. Ursula Burns is the chairwoman of Teneo. She is also on the boards of Uber, Endeavor Group, and TSMC, as well as a number of educational and nonprofit boards, including MIT, the Ford Foundation, and the Metropolitan Museum of Art. Paul Keary is the CEO and a co-founder of Teneo, leading this firm of 1,700 people and its 5 business lines spread around the world in over 40 offices, and maintaining a direct, trusted advisor role with many key CEO clients across industries and geographies. Ursula and Paul, thank you very much for joining us. So Paul, maybe I can start with you with the sort of the big picture takeaways from the survey, which, as I said at the top, showed sort of overwhelming optimism on the part of CEOs and investors alike for the growth prospects, at least for the early part of this administration and this part of this year coming up. But what were the key takes for you and how you're interpreting it?
This was year 3 of our survey. As you know, we started this because we wanted to mine the views of public company CEOs around the world, people who run those businesses, and then also talk to the men and women who invest in those companies and those industry sectors. Initially, to see was there any major divergence of views on the year ahead, but also to think about what are the big themes and topics. So this is a particularly important year because we had elections all over the world. As you've referenced before on your show, about half of the world's population went to the polls this year, obviously here in the US as well. So it was really important to get the pulse of CEOs and investors after the conclusion of the US elections. Big takeaways, I think we would all probably agree, would be is this soaring confidence in the global economy and the domestic US economy, its likely performance next year, particularly the first 6 months. There is definitely a correlation with Trump's election victory here in the US, called out by CEOs investors as a primary driver of that optimism. And third, CEOs and investors are not blind to the challenges of tariffs, of trade, of big geopolitical challenges in China, in the Middle East, in Europe. But despite those challenges, they're really marking 2025 to be a year of growth.
And so, Ursula, we're going to dig into some of what Paul was just talking about and some of the more granular details that emerged in the survey. But what were your kind of big takeaways so far?
Well, I think I agree with Paul that this has turned out to be, as you would expect, a boon for business. It's a boon for business confidence. It's a boon for the richest people in the world, the richest economies in the world. Because this is a friendly to trade, a friendly to growth administration. It's also one that it seems like there'll be a little bit less attention on the details and a lot more like the shiny object in front. So businesses know how to play in that world very, very well. And you can see it already, people lining up to kind of meet with the man and figure out how they fit. As a past CEO, I would be doing, unfortunately, the same thing, right? Which is to figure out where you can actually optimize and maximize your operations, given the reality of the day that we now have I call it Republican prime administration. So I think that they're doing what they expect. I think that they're going to get caught a little bit if they don't pay attention to their employees around their employees and around these kind of hidden things that have already been planted and already growing around ESG, around equality and inclusion. These areas they're going to have to pay attention to. But for the first 6 months, they're going to do, I think, what we think. January to June It's going to be, hold on to the doors. We're going to open it up and see just how fast we can run.
And do you think does that explain, because one of the most remarkable findings at the headline level on this was that some 77% of global CEOs felt optimistic about that the global economy was going to improve in the first half of this year. And that was a 32-point improvement over the same question asked of them last year. What was interesting was that last year, a majority of large cap CEOs thought that the first half of 2024 was going to be a deterioration in global economy. They were wrong about that. But Wall Street, the investors participated in our survey, got it right. Now this time around, both seem to be basically equally optimistic. But would you say it's what Ursula just explained right there kind of explains that delta, that kind of 32-point jump in views on the economy?
I think all those elections and the conclusion of the elections is helpful for everyone, right? You know what the regulatory and legislative regime is in India. You know what the Keir Starmer priorities are likely to be in the UK. The European elections have presented some data which makes it easier to plan against that, in the US we discussed. So post-electoral stability and conclusion gives confidence. I think there's a lot of data from the Trump administration's first 4 years. The 4 years of him pretty much been always on campaigning as to what his priorities were going to be. Lower regulation to support business growth, potentially lower taxes. Couple that conclusion to the elections, the Trump orthodoxy around lower regulation and lower taxes, coupled with there's just a lot of capital that has to get deployed. And all roads are leading to the US. It's not as surprising, I think, that the confidence level is high. Maybe the 32-point jump is definitely surprising, but access to capital, about $1 trillion alone in private equity has to be unleashed on the markets.
Yeah.
There's a lot of reason to be hopeful rather. And there's a lot of reason to think that the US market's going to be a net beneficiary of all this hope and optimism.
So what do you think? I mean, the survey was conducted in the 3 weeks immediately following the election. And so I get this point that, amongst other things, people were probably euphoric over the notion that we knew what the outcome was going to be. We weren't going to have a January 6th. There was not going to be any question as we headed toward the handover of power. And that in and of itself gave people confidence to start thinking forward. But do you think that there's an element of pricing for perfection here to a certain degree? You point out lower taxes and lower regulations, Paul. And there seems to be, looking through the data in the survey, there's this kind of feeling that, yes, the Trump administration and its supporters in Congress are going to follow through to the letter on those campaign pledges. But on other campaign pledges, say maximalism on the tariff front, maximalism on the immigration front, potentially interfering with the independence of the Fed, that he is not going to go down the maximalist route on that. And I'm just wondering, are we being too Pollyanna-ish about that when we don't really know what's going to emerge yet? And I would just point out that, just last night, the president-elect is not yet in office, but we have now kind of blown up the continuing resolution deal, and it's unclear. We may have a government shutdown as early as this weekend. That sort of chaos is already starting to emerge, and the Fed indicated yesterday as well that they are probably going to be slowing the rate of now the swaps market is pricing in only two rate cuts next year. And we've given up all the gains, all the post-election stock market gains. So do you think that they are too Pollyanna-ish here and we ought to apply the brakes here a little bit, or we cut through all of that?
Yeah, I don't think that it's too Pollyanna-ish at all. No matter how we look at it, there were two choices on the table in November, right? There was a choice of high regulations, speaking to the masses, bringing the many different classes closer together and closer to the middle, and the other side, which is what won, which is big business is good for America, it's good for economies around the world. CEOs and business leaders kind of know what to do, leave them alone, forget all of this other social stuff that you guys are talking about. Those are two choices. And the choice that businesses are living in now after that was made is one that is definitely easier for them to operate in. That is literally, let's go for growth. Let's do it in a way that is okay, but we're not going to overregulate you. We're not going to overwatch you. Literally do your thing, make as much money as you possibly can. And the one place where I think is a big gap that's going to show up more and more, you say, lower taxes, except for if you happen to buy something that comes from one of these high tax, we're going to pay for it. The consumers are going to pay for it. That, if he does go through on tariffs, it's going to be hard to reconcile this lower taxes and higher reality of just about everything you buy costing a little bit more money. But I think for business, this is not a bad time at all. I mean, the overarching story is you don't have to really worry about these guys in Washington slowing you down as much as you would have had to worry if we had a Harris-Walz administration. And that's, do I like it? It almost doesn't matter, right? For business, it's literally right in their wheelhouse how to manage this kind of dichotomy. They know how to do it.
Yeah.
And I think CEOs have also, as a new muscle that they've had to develop, which is having this being disruption proof or being disruption resilient aware. So as I mentioned, they've had 4 years of a President Trump. There's a lot of data available as to which is rhetoric, which is likely policy, his worldview on business and economic issues. So that is a known disruptive set of outcomes or challenges in the next 4 years. Since President Trump was in office, we've had the emergence of AI as one of the great disruptive technology transformations in all of our, I think, most professional lives, at least in the last 20 or so. And CEOs have now embraced and realized and understood how to move through that technology disruption. And we've had, for the first time in this CEO suite's, I think, life in senior management positions, we've had a deglobalization. So the new CEO class coming in and the current CEO class are majors now in disruption management. So I think some of this confidence is as a consequence of we've done it before, we'll manage through it. We actually potentially know how to find advantage in this disruption. It's a new class of CEO. Even if it's the same men and women in those seats, there's a new muscle that they have that a previous generation didn't have to have.
So one of the things, and if I could just continue with you, Paul, one of the things you've been talking about as we headed into this next administration is that this was going to unleash M&A. And indeed, the survey bears that out, that sentiment out as well. I think 80% of CEOs expect major return of M&A. A lot of that due to greater ease of access to capital, but also the animal spirits unleashed by this Trump administration. So talk about how you see that kind of manifesting itself, and is it kind of an across the board thing, or Trump won. He did block or attempt to block some mergers, so it's not just an across the board unleashing. But what are you looking at?
Well, last year, interestingly, the study also, not to the same extent, but CEOs were expecting, and investors particularly, were expecting 2024 to be a bumper M&A year. I think what the market broadly hadn't factored in was potentially how challenging the regulatory environment would be. And I think how disruptive the political electoral process around the world would be, where a lot of capital stayed on the sidelines until we understood what was likely to be the new political regime across the world. So I think that held back M&A in ways that people hadn't expected, because the capital was available. The capital remains available today. So I think M&A will see a boon because of the regulatory environment reality that Ursula referenced. Because there's way more capital. It's just continued to stockpile in the interim period. And I also think on the basis that certain industries have been boxed out or felt boxed out. Some of the big regulated industry like banking, healthcare, pharma have been boxed out by the Biden administration from a regulatory perspective, which feels that there's going to be an unleashing of deal flow in that space. And there's been historically low levels of M&A in technology and healthcare and media as well. So the law of big numbers suggests that we're going to have a blockbuster M&A year. But that's more importantly than what I think. It's what CEOs and investors around the world think.
Do you think, one of the bête noirs of corporate America in the last 4 years has been Lena Khan, obviously. But J.D. Vance, the vice president-elect, has expressed sympathetic views to some of her positions, even if he comes at it from a slightly different angle, particularly with regards to big tech. Do we have a view on where tech is going to, and particularly the big platforms? And clearly, we have seen the CEOs making the pilgrimage to southern Florida just in the last few weeks.
I think we have a little bit of a wild card in Mr. Musk in this whole conversation and how he influences this whole space. You know, it's not really his remit, but I think he will have a lot more influence than we think and are factoring in. I think M&A, I'm generally for, and this is not a personal, I'm generally for across the board combinations if they can drive efficiency in a way that would not seem to be consumer advantaged. Having an inefficient platform out in the marketplace just so that we can have two platforms doesn't make a lot of sense to me. And I think that, and nor does it to many business people. So I think M&A it's been held back for sure. Part of my business is here. It's definitely been a hard row. And I think we're going to unleash a lot of potential deals that I think in the long run will be better. Better for U.S., better for the economy, better for the consumer. So I'm not really that afraid of it. And I think done well by good meaning CEOs, it'll be okay in the long run. But there is this thing about what Musk thinks is reasonable or not, and whether he starts to actually play the game in such a way that's leaning towards his interest, right, versus the nation's interest. I don't know enough about it to know what he's going to do, but I don't feel really comfortable about it.
So, Paul, a few minutes ago, you said all roads lead to the U.S., and for the reasons we've just been talking about here, why the U.S. will be the single most attractive investment destination, and that's borne out also by the survey. Talk a little bit about, because the survey was conducted to global CEOs and global investors. Talk about rest of world and opportunity there as well, and what you're seeing on that front.
Yeah, I think the majority of both cohorts, CEOs and investors, felt that USA was the most attractive investment destination. Hence, the all road lead to the USA comment. In APAC, India, interestingly, year over year, has emerged as the most attractive destination for investors within the APAC region. And that is not surprising, perhaps, when you consider the reality that CEOs have had to diversify their supply chain, diversify some of their market exposure, and India has been a net beneficiary of that deglobalization. I think Europe has faced significant challenges, well documented. In Germany, there's some economic challenges. In France, you've got some political challenges. And in the UK, you've got an emerging industrial policy from a strong new mandate from the Labour government. So change is expected there. As a consequence of all this, I think USA just presents itself with a known set of potential economic outcomes. A regulatory environment, to say it again, that is likely to be easy to invest behind, and an advantageous tax structure. The US has been probably the net beneficiary of the AI movement over the last number of years for those reasons.
Yeah.
The USA perspective was not a regulate first perspective. It was to welcome IP, to welcome capital that was going to tackle the big AI issues. And as a consequence, some of the smartest men and women in the world are in the US trying to solve those issues. But they came from different markets around the world. So this primacy position that the USA enjoys is not just all a financial metric. It's a great place to do business. The regulatory environment is not absent. It's just supportive of capitalism and entrepreneurs. And there's an excitement in the market right now, independent of who's in office. There's an excitement about USA's position. And the America First economic agenda, I think, plays into it rather than has driven that.
So, quick follow-up question. Interestingly, 76% of the CEOs surveyed in here believe that the outcome of the 2024 elections, not just the U.S. elections, but the elections worldwide that you referenced a minute ago, improved global stability. And I gather some of that is an element of okay, now we've got some certainty in a lot of countries, and we can now base decisions on that certainty. But I was interested because you've been spending a lot of time in the Middle East of late, as have others of colleagues of ours as well. And there's been a lot of enthusiasm, particularly in the Gulf states. Obviously, we also have a lot of turmoil in the region. But one of the interesting findings in the survey was that only 12% of MENA-based CEOs felt positive about global stability in the survey. And do you feel that when you're in the region?
December 19th today, I was there a couple of weeks ago.
Yeah.
Overwhelming, so the Middle East writ large is different from the GCC. The GCC are exporting and importing capital at levels that haven't been seen historically. More closely aligned, I would say, in the GCC nations, more closely aligned with the expectation of global growth in the US market, and more aligned with the big technology trends than I would think that the MENA region writ large. So those economies in the GCC are amazingly resilient despite big geopolitical shifts that are happening in their backyard versus some of the other, I think, more regionally dependent economies in the MENA region. So I think that probably explains the 12% number.
Yeah. You know, Ursula, as I mentioned in the introduction, you sit on the board of TSMC, so you're acutely aware of the sort of the trade and tariff balance between a lot of countries. And one of the interesting divergences, again, in the survey was when it came to tariffs. And 80% of mid-cap CEOs felt that a tariff regime was likely to have a positive impact for their businesses, whereas only 13% of large cap CEOs did. Now, presumably that's due to the more internationalized nature of large businesses and the like. But I wonder what it means, because do we get a sense of whether the respondents were thinking about sort of a selective set of tariffs and doubling down on certain industries or certain products, or this more pervasive across the board, these sort of shots across the bow we've taken at not just China, Mexico and Canada and other places, and what's the anticipation of the retaliation by the United States' trading partners? So,
separate from TSMC, this is an answer that has nothing really to do with TSMC, also because I shouldn't be saying a lot about what has to happen with TSMC. The fact of the matter is that there is a reality that some of the things that we are targeting, that the United States is targeting, the Trump administration is targeting to tax, there are no options to get anywhere else. If you want an advanced chip, you can say all you like about whether these guys were good, bad, or indifferent. You can buy it from one source today, one source. Maybe 1.25 sources, but that's it. So I think many CEOs, particularly large company CEOs, understand their supply chains well enough to actually it's just part of the game. It's part of how we are going to have to operate in the future. And they will generally, because they use it in the supply chain, not at the outcome, not at the end, they will generally be able to kind of stand harmless from what's going to end up hitting the consumers of higher prices and the like. Mid-cap is where the smaller companies is where it's going to really hurt. They absolutely will require they are in front, next line to many of the consumers, and have to deal with the pushback of what has to be, if it's implemented the way that President Trump talks about it, which will have to be higher prices at the pump, at the cash register, at the whatever the heck it is. So I think that the survey showed the reality of the two different types of businesses. If you're large and globalized already, you're kind of dealing with the reality of there may be some higher prices, but you have no options. And if you're smaller and literally are dealing very locally, I think that they're going to be disrupted a little bit more. At the end of the day, there's nothing we can do. If President Trump decides to do what he said he's going to do, heavy taxes on things coming in from Canada and Mexico. I don't understand really why that would be the case. Really heavy taxes on China, and really kind of an offensive move against places like Taiwan. I think that American consumers are going to have to hold on to their pocketbooks because they're going to lose a large amount of money. There is no way to implement what he has said he's going to do in a price-neutral way to most consumers. It's impossible to do. So, and by the way, we knew this before and people voted for it anyway, so I think that they must be ready for it.
So what's fascinating about that to a certain degree is that, you know, the name of the game, particularly in the post-pandemic era, has been decoupling or de-risking manufacturing supply chains from China and reshoring, nearshoring, friendshoring, whatever the term of du jour is. And if there's been one policy that's been bipartisan in nature in Washington in the last several years, it's been China hawkishness. And yet, the survey shows that when the question is asked, how important is China to your business now and in 5 years and in 10 years, that number, since we started this survey 3 years ago, has only gone up. Paul, how do you reconcile that sort of the political impetus on China right now with this business reality?
Yeah, I've thought about it a bunch. I think it's because year over year, CEOs particularly have spent more time diversifying supply chain, working through the consequence of having lesser opportunity in the broader Chinese market. I think their investors understand the challenges that they're facing. So I think they've de-risked and I think they've duplicated some of their supply chain issues. And as a consequence of that, the known challenges have been met or managed. And then you look towards China and you think about it still is a significant market. It still has a huge growth opportunity. And I think post-election confidence also comes from the fact that businesses expect the rules of engagement with China will be now established. What is a fair and appropriate industry vertical and where to engage China? What's not a national security threat on matters of technology? Could the Trump doctrine on trade and tariffs lead to an agreement between the US and China? I think there's a factoring in of hope. There's also a realization that they've best prepared themselves for a continuation of this deglobalization. And that's why you can't ignore China.
Yeah.
So doubling of reflection on the importance of China, there's not a doubling of the confidence that China will be opened. I think there's a hope aspect to that, though.
You know, if there's one thing that managements and boards have invested time, bandwidth, political capital on and whatnot over the last several decades, it has been positioning themselves in China, to Paul's point. Do you feel like, as they have looked to diversify and build, greater redundancy and resilience into their supply chains in other markets, that they understand these places as well as they came to understand China and are as networked? In other words, in Vietnam, in Mexico, in Hungary, and whatnot. Because Vietnam, as we speak right now, is going through an almost wholesale rejiggering of the highest levels of government for the first time in a long time. Nobody really knows exactly what comes out of that. Even India has not been as well understood by a lot of CEOs as China. So where do you think they are on this learning curve?
I think that they don't know as much, but I think it's not important that they know as much as they know or should know about China. It's that they're just different market impacts. Vietnam does something good, bad, or indifferent to an element in the supply chain or to some global risk profile. Very, very low, a lot lower impact than this one. There are two nations that actually can have this big an impact. One is clearly China and the other one is India. And so understanding from a market perspective, right, even from a geopolitical safety perspective, these are two places that you have to pay a lot of attention. And I think not knowing all as much as you should know about what's happening in Vietnam or Myanmar is not really that big a deal. By the way, I think that they'll come up to speed as quickly as they have to. China is like an urgent thing you should learn about. India as well. I mean, a lot of people have been in and out of India for decades and decades and decades, so I think understanding it a little bit better. I just don't think that the impact is big enough for them to actually, or need to be, or are as steeped in the ups and downs and the politics of the space. But just about every company that's reasonably sized has an expert either in their own home, or they partner with companies like Teneo to actually get some insights. So I think they'll be well enough prepared.
So I want to shift gears here to another area of the survey that actually yielded some really interesting answers, and that's ESG, which obviously ESG is a three-letter term that's become a four-letter word in certain quarters. But what was interesting is that 56% of the CEOs surveyed said that they would they were going to balance ESG priorities with the core objectives of the company. And I'm wondering what you think that phraseology means. And because also 91% of those CEOs said that while they've recalibrated their ESG initiatives, only 25% suggested in any way that they were actually scaling back. So how do you read that?
So ESG is never static. It's a dynamic obligation that companies have to their shareholders, to their employees, to their consumers, to those that regulate or legislate the industry. It's constantly evolving, it's constantly being tweaked, and CEOs are constantly subject to the political and legislative environment. And they're the ones that have to try and manage through those changed personalities with changed focus points. I think, one, intellectually, honestly, have to give CEOs great credit to face off against those threats and those challenges and those changed political dynamics every time. So I'm not a bit surprised that companies are saying that they're changing some of their ESG priorities, relabeling it, even some maybe defocusing it on some aspect, because they have to work within the environment where their license to operate is bequeathed by the regulatory or legislative environment and the stakeholders that buy their products or services. So that's one point. I'm not as taken by the activist nature of ESG. I'm not as despondent or overzealous about these changes. I think companies tend to do the right thing in the long arc of history all the time. The piece that was most interesting, I think, for me is despite all this change, despite some of the political pressure on companies to change, there's almost 100% acceptance that their core priority is to attract and retain diverse talent. You need a diverse workforce that represents the consumers and the communities that you live in, and there hasn't been any dilution of that core priority. So I think we live in a time of another point of disruption is ESG that CEOs have to manage, and I've never worked with a CEO who doesn't want to leave the world a better place from whence they found it. What they have to do, however, is to manage the politicization of this, and it'll shift again. The next pendulum will probably occur in the next election cycle, but those companies always tend to do what's right. Yeah,
to that point, I mean, Ursula, I know this is a major issue of interest to you. We've talked about this a lot on this program. But one of the interesting questions in the survey was, in light of recent backlash against DE&I, how are you thinking about your DE&I programs? And 48% of the respondents, actually a plurality, said that they were increasing their DE&I programs, and another 46% were continuing. So that's a huge majority right there. And interestingly, 0% of the institutional investors surveyed desired companies to end DE&I efforts at all, to Paul's point. And so 94% of those surveyed said they saw the value in continuing to pursue a diverse talent pool in their companies. So, does that match up with what you're seeing and feeling out there? And I do wonder, after the years of being more explicit about DE&I, both talking about it and implementing now institutionalized programs, have managements kind of bought credibility with their stakeholders so that if they don't speak about it as much because of the political environment we're talking about right now, the employee base and the customer base and others you're trying to attract see that, the fruits of what your programs have been?
That's a great question. I think I differ a little bit from Paul's belief that most business leaders, that a large percentage of business leaders actually think about leaving the earth a better place. I think that they do, but I think a large number of them don't have the strength of position or performance or whatever to fight a fight when it comes to them. That is where they're going to have to defend DEI against some short-term desire of some external constituency. So I worry about that, and so I don't think that some CEOs I know are there. They're willing to have the fight standing in front of the courthouse, and a large number of them would just prefer that I'll just do what I have to do, just don't bother me. That's one. So that aside, I believe that what we found in the survey was what I hoped we would find. And that is that these people are human. They know many different types of people. Generally, they don't look at them the way that DEI requires that you kind of analyze it. And they are willing to lean in and just kind of make their places attractive places to actually be employed. They want good talent. They know it looks brown, black, male, female, and so they are just marching along and just trying to stay abreast, right? Particularly in tech. You know, a lot of tech and medicine are the two places I spend time on this, and both of these places have to be color blind, gender blind, a whole bunch of things just to get enough people to come close to the door. So they've already said, you know, I'm not going to screen for women. I'm not going to screen because we need just good people walking in the door. And I think that's a tailwind for talent around the United States to actually have a little bit more say in how they end up. Most companies, most CEOs don't think about this the way that we analyze the data, right? They think about it as, I need a great person to help me solve these problems. And they don't really lean into, I need a great woman, I need a great man, I need a great person. And then they look at the results later and try to adjust programs. That's part of the problem, right? So now what they're doing is actually reaching out more broadly in the beginning so they have the option, or at least the possibility of getting a diverse pool. So I think at the end of the day, we asked CEOs to do things that were illogical, speak out loud about all of these things when we knew that if they did speak out loud, you have some of these really aggressive activists against a cause. There's no need to go that far. Just do your thing. Hire your people, train them very, very well, make sure that they're differentiated amongst each other, and you'll be okay.
Yeah, but just I agree with you, and I think it's a good format to have this discussion, right? The podcast format, which is, there's a D&I and ESG is one of the polarization issues of our time. There's a range of other issues, and companies are largely seen as a problem child in that dynamic. They're not doing enough, they're doing too much. One could also easily make the separate related argument is that it was the shop floor, the factory floor, the office floor, the trading floor. This is the safest place to be diverse and to have diverse political opinions or racial profile. You never see the sort of discord that you see on the streets or in media represented in businesses. Because people focus on working together to produce a good or product or service. Actually, it's a broader conversation, but companies and CEOs should be held up as, how do you guys do it? Rather than constantly getting beaten up for what they're not doing enough of.
I would agree with you.
The safest place to be different is the American workforce.
That's very interesting. And you know this particularly because on the university front as well, you see the exact sort of opposite in a sense. So, part and parcel to what you've just been talking about, one of the more prominent actors in recent years then has been the sort of the political activist investor, right? And I'm wondering if just the toning down of leaning in rhetorically and talking about all these issues, even if you're not changing anything in terms of what the outcomes are, will that be enough to call off these types of investors? Or do you think this is, when you talk to our DE&I and ESG professionals here and our IR professionals here and the like, what are you hearing about what the defenses are, or are these guys going to go away?
They're not going away. Give me a break. There's a concerted effort here to change the progress rate and outcome that the United States has been on for both gender and ethnicity, racial, for sure. This is not a game. The Robbie Starbucks of the world, the administrations of the United States actually do not want equality. They do not want it. By the way, America has said maybe we don't want it either, but the political infrastructure, particularly the Trump infrastructure, has made it very clear that there are certain types of places that we can go. There are women, black people, whatever. There are certain places you can go and that you shouldn't. We can't avoid the last year of campaigning. The words are very clear. And we can actually say, okay, it doesn't matter, whatever the heck, but he's made it very clear where he wants to be. I think this struggle, it doesn't happen, and it shouldn't necessarily happen in the C-suite of all the companies around the world. The conversation has to be had there, but it also has to happen in the streets, in the churches, in the schools, in the people who have voices, because I mean, unless I missed something over the last 12 months, it's been clear. We don't want you here. We prefer if you stayed wherever the hell you were, but not where you're heading, and just leave us alone. And by the way, we're going to legislate that. We're going to actually try to drive it legally through structures. I don't believe that we can now say, oh yeah, it's going to be okay now. He's been clear. He told us who he was.
The activist issue is relevant as well. We, as a firm, as you know, Kevin, we always represent the company, the institution that's been challenged by an activist.
Yeah.
Financial, political, geopolitical, whatever it may be. I think there's space for activists. There always will be, because there's a certain cohort of people who believe their view, and then they're a mouthpiece for that particular cohort. I think what's changed for companies is that there's like a Moore's Law application of this. New activism challenges emerge every couple of years, right? The financial activist is a relatively new phenomenon. The political activism is a relatively new phenomenon. The ESG activism is a very new phenomenon. Again, it's part of this constant disruptive environment that companies need to operate within this juncture. But I think companies need to understand that those activists play a role, but the long arm of the history of their company is about navigating through this, making sure they're focused on what are the stakeholders that own their company, buy their product, buy their service. But I'm saying the same point I made earlier. Companies should be studied by the political environment as to how you do this well, rather than being subject to the largely, the bully pulpit.
So shifting gears to innovation, and companies are obviously always looking to innovate and always looking to make sure they're not behind the curve. And Paul, you alluded earlier to AI. And one of the things that was striking about this year's survey was that the respondents were asked to comment on whether they were making further investments in a number of areas of technological sort of advancement right now. And it was more evenly distributed last year. This year, it's all in on AI. Actually, one of the most significant ones was crypto, where CEOs are devoting almost nothing now versus last year. Which is interesting given the position crypto has had in this year's campaign and the like. But I'm wondering if you could comment a little bit on what you're seeing on the AI front in C-suites in terms of where companies and CEOs have kind of gotten on the learning curve on this, on how they're implementing it, what their concerns are they being efficient about it, are they getting the returns, are they seeing the returns as yet on this? What's the dynamic?
Yeah, I'll make a comment, and considering Ursula ran Xerox and Vion and has invested in technology companies, she's forgotten more today than I know. So I'll keep it brief. So I think the survey, however, revealed that AI is the number one investment technology, quelle surprise. Crypto and quantum was more a mid-cap focus as a priority investment. I think also CEOs are more judicious as to when the ROI in that AI investment is going to take place, and investors are more expectant that it's a 2025 H1 matter. So then again, CEOs have worked through disruption in technology. There's just worked through changes. So I think their expectation is the ROI in terms of internal efficacies, the ROI in terms of how it manifests itself in a Web3 environment is still too early to make broad predictions on. So they're trying to manage expectation appropriately. But the secondary point I would raise is that what do CEOs expect for their successor and their successor's successor? They expect that new leader is going to be data fluent, digital native, and is going to be emerging as leadership with transformation and disruption as a primary experience set. So that I think they're handing the baton to the next generation, saying, you folks are going to be running this company in a very different digital environment. Ergo, the CTO for the first time has emerged as a real credible successor point, in addition to the CFO and the COO to the CEO.
And I think it's what I always say, this what I would expect, right? When AI first came out, I remember when cloud started to be the thing, right? Every speech that a CEO made after cloud became a hot topic included the word cloud in every paragraph. You had to say it 20 times, even though most people were doing nothing on it. a couple of years ago, that's what AI was. It was like, you have to say something. Who the heck knows what we're doing? What I'm seeing in all of the businesses that I'm engaged with, either on the board of or public, private, is that people are now, business leaders and businesses in general, are now a little bit more versed in what they could use this for. Like the real conversation is not that we're doing some AI stuff. It's very specifically that we're doing AI in insurance. It's literally on making sales pitches to future clients, et cetera. So I think that the conversation has matured in that CEOs now more and more, after playing around with this for a couple of years, are learning exactly how useful it could be in their business, and in many cases applying it 1 or 2 or 3 times. In some cases, I mean, when I bought at the Mayo Clinic, this is like front and center to how they, provide care. So I think it's a natural kind of a progression where you had to defend yourself in the beginning, to say the words and we'll figure it out. And now it's like real, we kind of know what we could do with this. It's still, I think 3 years from now, 4 years from now, it's going to be even, it's like cloud now. Nobody even talks about it, but it is there. It's everybody's infrastructure is on the cloud. You're going to find a large amount of the businesses, small, big, small, here, there, are going to be, it's going to be in their lives. We have to watch as business leaders, as educators, as citizens of the world, exactly how we want this to come out. And this is where a lot of the discussion has to happen. How do we want this to come out, if you can even think that far ahead, and at least try to legislate, either socially or legally legislate towards that outcome? Because if we don't, it's just going to be like it's going to be like social media, where, it kind of shows up and you go, oh my goodness, that's not what I expected it to do or where I expected it to be. I hope we were a little bit smarter about AI than we were about social media, but I think it's unstoppable now, and it's becoming more and more natural. Not this like, oh my God, we don't know what to do,
So you guys have covered a lot of territory on some pretty weighty subjects here, and I want to kind of land the plane by asking you 2 last questions. And Paul, in a way, you kind of teed it up, but as Ursula, you sit on a number of boards. Paul, you not only are CEO yourself, but you advise a lot of CEOs and try to help them excel and deliver on the objectives they've got. So this changing world that we are in, technologically, the political world that we're in, just the geopolitical dynamic, and does it represent what we went to school thinking we were going to be in, and so on and so forth. Talk about the leadership qualities in corporate leaders that you think are, is the weight changing of what of what you're looking for in corporate leadership now than it was in the past, or is the skill set changing? Is it going to be a different pipeline of people who are going to probably be in the discussion for the CEO position itself going forward? How do you see that?
There's definitely going to be a different set of technical skills needed. I agree with what Paul was saying earlier about the idea that you could be a good general manager, and actually I'm just a good general manager. I know a little bit about everything. It's going to be less important than I know a lot about certain things, and totally, just you're going to have to be technically astute, a lot more technically astute, and I think you're going to have to be stronger, because the constituents now. When I was CEO, basically you delivered a bottom line, top line, bottom line. That's it. Go off and do your job, and if you did those 2 things, you kind of got air cover from your board, you got air cover from your employees, even if they didn't love you, but you got air cover. Those days are absolutely done. You need to do those 2 things, and you have to be able to actually have a position and explain it in a way that people buy it. It's almost like an actor. They're not necessarily acting, but it's like an actor. You have to be able to not only you have to be able to know the words, but you have to look the part. And looking the part is have a strong position and be able to articulate it, lead your company through a lot of just soft stuff that you don't even know how to measure. You know a lot about technology, know about the globe, but kind of stand in position in a way that your constituents can actually see strength And I don't mean like, men carry, I just strength, calm, organized clarity. I think that's more than ever going to be, you have to pass that before you can even get in the door.
Yeah, I'd agree with all that. I also think it's wild how stressed the world seems to be and how stressful everything seems to need to be. It just makes no sense to me that like less people are hungry, more people are in the middle class, great art continues to get produced.
I agree with this.
Great moments of sport and culture happen all the time. It's a great time to be alive.
We've talked ourselves into being absolutely unhappy. And it's just pervasive. I mean, they say, well, I'm just unhappy. You say, okay, what about America's not doing well? And I say, by the way, we know it's not doing as perfectly as we want it to do. But I think we've actually doubled down on this rhetoric that, it's a disastrous place. We are, we're not proud of our country. It's just a strange thing when you look at the data and you say, my God, as you say, less people die, less people are hungry, more people are educated. Every thing, more people on boards that are, but it seems worse than it is. And maybe it's that we see too much. Maybe we're too aware.
We're algorithmically rewarded for outrage.
Yeah.
At the end of the day. Yeah.
Yeah, that's a very smart thing you just said.
Yeah. It's just a strange position to be in. And I think we need to make sure that as business leaders, we had a meeting earlier today about ESG in Teneo. And one of the things that you have to step back and make sure, I think as a business leader, is that you're clear after a lot of input from the constituents that you need input from, that you as the leader stand and be very, very clear about what your company is going to do and stand for. And this idea that you can be in the middle and try to please everyone, we found, we knew this all along because we have children and families. You can't please everybody all the time, and we have to be clear and kind of strong as we lead people through things and kind of turn this away from immediate gratification right now, and I love you, even though you're standing on A side, and I love you, even though you're standing on X, and we'll be able to give everything to everyone. The answer is I do love you, but we're just not going to be able to give everything to everyone because either we don't agree with it, or two, we can't afford it, or both, right? So it's a strange time, I think, in the world, but definitely in America.
So, Paul, I'm going to give you the last word here. The world that the two of you have just described in this last minute, but also over the course of this conversation, for the CEO clients of this firm, it is clearly a more complicated and more fraught period. And by the way, average CEO tenure is not that long you've got in which to accomplish the goals that you've got and deliver to next gen of management, a company in a better position than you got it. So as we look at 2025, after everything we've just gone through, and yet, go home and get some rest over the holidays because buckle up, it's going to be a bumpy ride next year, right? How do you find yourself right now, when you take everything we've just learned from this survey and hear the anecdotal evidence specifically from the voices of these CEOs directly to you asking for your advice, where are you spending most of your time right now? Where is the biggest kind of return in terms of the work you're doing with CEOs for their benefit going into next year?
Yeah, I think to quote, I think it was the late Senator Moynihan who said statistics are the plural of anecdotes. So the anecdotes in my day-to-day are CEOs and the C-suite in general are hopeful because they're naturally predispositioned to be hopeful. You don't get to run a large public company with an important product or good or service if you don't think that service is important, if you don't think that your company should be winning, if you don't think that the world needs you. So I think the anecdotes I pick up every day is that the reaction to the election in the US is not just a manifestation of one's political views. It is a genuine hope that this new chapter, which was a clear chapter in terms of the election result, not just in the US but around the world, is going to enable people to turn the page and move on with doing what they do best. Running a company, developing a product or service, meeting the challenges of the day. So I'm more hopeful than anything else that the anecdotes of hope will meet expectation, and somewhere along this in 4 years' time, we'll be back into the markets again politically in the US, but we'll be a little bit better as a society. I hope so. I think we can be.
We have just scratched the surface on all of the data available in this new CEO and investor survey, Teneo's Vision 2025. It is available on Teneo's website, teneo.com. I want to thank Ursula Burns and Paul Keary for being here with me
Kevin.
today to explain their thoughts on the findings in the survey. This is our final episode of 2024. Happy holidays to you and your families. Get some rest. We'll see you in 2025. And until then, I'm Kevin Kajiwara in New York.